The book Random Walk Down Wall Street is a pioneering book in the world of investing and the stock market. The book explores the concept of random walk in investing and encourages investors to avoid predicting market movements and trades timing accurately. It presents evidence and studies that support this approach and advises adopting a long-term investment strategy and diversifying the portfolio. This book is considered an important reference for both beginner investors and professionals who want to understand the fundamentals of investing and achieve success in the stock market. A Random Walk Down Wall Street by Burton Malkie. The first element addressed in the book A Random Walk Down Wall Street is the concept of random walk in the stock market. The book presents a different perspective on the investment process and encourages investors to avoid attempting to predict market trends and market timing accurately. The concept of random walk challenges traditional beliefs in the world of investing. According to this philosophy, attempting to predict market movements and accurately select winning stocks is extremely difficult, if not impossible. The book provides historical evidence and studies that support this conclusion. According to the concept of random walk, investors should rely on a long-term investment strategy, which includes a well-diversified portfolio. Instead of trying to forecast short-term trends and speculate in the markets, investors are advised to achieve a good asset allocation in their portfolios, such as stocks, bonds, and alternative assets. Diversification is considered one of the foundations of the random walk strategy, aiming to reduce potential risks and increase opportunities for achieving average returns over the long term. The historical evidence presented in the book confirms that the random walk strategy can be effective over the long term. Studies have shown that most attempts to predict market movements and select winning stocks fail over the long term, and the results often resemble random distribution. The philosophy of random walk in investing acknowledges the random and unpredictable factors that influence financial markets. Therefore, investors who adopt this philosophy seek to reduce the negative effects of short-term market fluctuations and enjoy the advantages of a long-term investment approach. Consequently, the book advises that it is best for investors to invest in financial markets regularly and through a diversified portfolio, without relying on market timing correctly or predicting the directions. Instead, investors should employ rational analysis and follow a long-term investment strategy to achieve success in the stock market. Bit to remember, investing in financial markets can be like a random walk, where one cannot accurately predict market directions or market timing. The second element addressed in the book is the impact of random factors on the stock market. The book suggests that there are numerous unexpected factors that influence the movement of financial markets, making it difficult to predict them accurately. General news, political events, and economic fluctuations play a crucial role in the movements of financial markets. For example, news of political crises or geopolitical tensions can impact the market and cause a sharp decline in stocks, while sudden economic fluctuations can disrupt the market and result in significant losses for investors. Random factors pose a significant challenge for investors as they struggle to predict these factors and determine their actual impact on financial markets. Investors may analyze data, study economic forecasts, and employ technical analysis, but they cannot guarantee what consequences these factors will yield in the future. Based on this, the book advises ignoring attempts to predict market movements and focusing on long-term investment returns. Instead of relying on market timing correctly, investors should focus on building a balanced and diversified portfolio that includes various financial assets and sectors. By emphasizing long-term investment and portfolio diversification, the impact of random factors on overall investor performance is reduced. When a portfolio is balanced, the negative effects of volatility in one sector may be offset by the positive effects of another sector. Additionally, the book recommends conducting rational analysis of stocks and financial assets. This means that investors should rely on fundamental company data and financial performance rather than expectations and technical analysis. Rational analysis helps understand the real value of assets and reduces the influence of random factors in making investment decisions. The book emphasizes that random factors significantly impact the movement of financial markets and make it difficult to predict their direction accurately. Therefore, investors should avoid attempting precise predictions and instead focus on long-term investment, building a balanced portfolio and conducting rational analysis of financial assets. Bit to remember, random factors have a significant impact on the performance of financial markets. This includes general news, political events, and economic fluctuations. The third element discussed in the book is the role of human minds and emotions in the investment decision-making process. The book emphasizes that emotions and rationality significantly influence the behavior and investment decisions of investors. Emotions is shown in the stock market through psychological effects that impact investor behavior. For example, investors tend to feel the desire to join prevailing directions in the market, whether ascended or descended, based on the prevailing emotions in the market and their desire to participate in profit or avoid losses. Another example of the influence of emotions on investment decisions is the psychological impact of losses. When investors experience financial loss, they tend to make irrational decisions and risk more money to recoup their losses. This is due to the negative emotions associated with loss and the investor's desire to compensate for the losses at any cost. Similarly, investors are also influenced by positive emotions such as ambition and excessive optimism. They may take on more risks or make non-considered investment decisions based on the positive emotions that encourage them to believe they will achieve significant profits. However, the book advises the importance of achieving rational analysis and avoiding investment decisions influenced by emotions. Rationality allows investors to evaluate data and information logically and analyze the financial performance of companies based on facts and numbers. Additionally, the book advises allocating time and effort to learn and understand their personal emotions and how they impact their investment decisions. When investors are aware of those emotions, he can better manage them and make more rational investment decisions. The book emphasizes the importance of understanding the influence of human minds and emotions in the investment decision-making process. It advises investors to achieve rational analysis and steer clear of emotionally driven decisions, along with allocating time and effort to understand personal emotions and their impact on their investment behavior. Bit to remember, the role of emotions and rationality in the investment decision-making process. The fourth element discussed in the book is the importance of education and knowledge in the investment process. The book emphasizes that learning and acquiring knowledge are crucial tools for successful investors. Education is considered the foundation for a deep understanding of the stock markets, their laws, and their instruments. The book advises the necessity of allocating time and effort to continuous learning and improving knowledge in the field of investment. Investors can read specialized books, attend courses and conferences, and make use of online educational resources to enhance their overall financial and investment knowledge. Additionally, the book advises understanding different financial tools and concepts. Understanding the basics, such as stocks, bonds, mutual funds, liquidity, and diversification, is essential for investors. This enables them to make informed investment decisions and understand their financial goals and risks. Furthermore, the book recommends engaging with professionals in the investment field, such as financial advisors, financial experts, and financial analysts. These professionals can provide valuable advice and guidance to investors and assist them in making appropriate investment decisions. Seeking the assistance of financial experts can help reduce risks and increase the chances of success in investing. Additionally, the book emphasizes the importance of striking a balance between general knowledge, academic education, and practical experience. Combining theory and practical application is crucial for investors. Theoretical knowledge provides them with the foundations and fundamental concepts, while practical experience gives them a practical insight into the financial markets and their challenges. In summary, the book underscores the importance of education and knowledge in the investment process. It advises investors to allocate time and effort to continuous learning and improving their financial and investment knowledge. It also recommends understanding different financial tools and concepts and engaging with professionals in the investment field. Investors should combine theoretical knowledge with practical experience to succeed in the stock market. Bit to remember, education and knowledge are crucial tools for successful investors.